Yes, very good evening, my dear friends. I'm sure we are audible for everyone. Kindly please respond once in the chat box that we are audible so that we can happily continue and proceed. Yes, wonderful, my dear friends. Friends, this is Shiva Teja here, Chartered Accountant. Welcome you all to the discussion on CA Final Indirect Tax Laws, the last paper of the entire CA curriculum. Nothing but indirect tax laws. Even though the last paper, it has got significant amount of importance. As I keep saying always during the lectures, that the moment we write the last exam, we always want to celebrate very effectively because we completed our last exam. In the same context, I keep telling the students that there should also be a very strong reason to celebrate your completion of examinations. And I would say that that strong reason should be your indirect tax laws. So without any delay, my dear friends, let's spend some good time for the next couple of hours and ensure that we get some good clarity of thought on a lot of interesting topics in our indirect tax law syllabus so that we are geared up for our preparation and geared up for examination standpoint and also from a practical standpoint. So we'll ensure that we will spend a couple of hours to ensure that we'll revise a lot of interesting topics and important topics in our syllabus. And the whole idea of this revision is to ensure that this revision will do some value addition and act as a substantial aid for us to ensure that our revision becomes more smooth and easier. So without delay, guys, let's start the discussion. So friends, as you all know that out of 100 marks paper, we have got division into GST and also division into customs. Almost about 75 marks come from GST and close to about 25 marks come from customs. And in customs, it is set very clear that a question will come from valuation under customs and a question will come very clearly from types of customs duty. So the syllabus of customs is actually very less. So where straight away questions will come in the exam and they are not trying to play around a lot of things in customs. So that is one such area which is actually very scoring, which you cannot afford to miss. Do you agree with that, my dear friends? Exactly. So, when I get into your ICI material, if you look at here very clearly, under GST, under customs, if you look at, pause for 2 minutes, we have got topic of introduction to customs. We have got topic of levy and exemption. From introduction to customs, generally a 2 to 3 marks question will keep coming in the exam where they will ask where customs duty is applicable. It is levied on what imports and exports. What is the meaning of the bill of entry? What is mean by bill of entry for home consumption, bill of entry for warehousing? And I'm sure we all know the fundamental difference between warehousing and bill of entry for home consumption. Home consumption is a case where we will pay the duty and collect the goods. Warehousing is a case where we are required to enter into a into-bond bill of entry for home consumption, where we'll execute a bond equal to thrice the amount of duty. I'm sure this basic knowledge we all have got. And we all know the customs procedure, what we have in customs law. That is, goods arrive at Indian customs station. Then person in charge files import manifest or import report with proper officer. Then proper officer grants entry inward. Once entry inwards is granted, the goods are unloaded, and the goods are unloaded only at approved places, that too on working days during working hours. And once goods are unloaded, goods are under custody of the custodian, that's nothing but customs officer. And after that, importer will come and file the bill of entry. It could be bill of entry for home consumption or bill of entry for warehousing. Third possibility also is there. That is called bill of entry for transit or transshipment. There is a small difference between transit and transshipment. That's a case where, imagine a person has imported goods from US and the same vessel, without unloading into India, is directly going to Australia. Now that is called as transit. But imagine a case where in India, the goods are unloaded and then the goods are reloaded into another vessel, and then the goods are being sent to Australia. Then that is known as transshipment. So transit is a case where there is no change in the vehicle. Transshipment is a case where there is a good change in the vehicle because the goods are unloaded and then the goods are reloaded into another conveyance. That is known as transshipment. Second topic, we have got topic known as types of duty, where you should have a clarity of thought on what is anti-dumping duty, when is safeguard duty levied, and let me make you recall the concept, my dear friends. That is, safeguard duty is imposed only to safeguard the Indian domestic market. But if articles are imported from developing country and share of imports of that article into India from the developing country does not exceed 3% of the total imports of that article into India, then safeguard duty is not imposed. One more interesting possibility, my dear friends, that is in case where articles are imported from more than one developing country, then if each country does not exceed 3%, and all put together developing country does not exceed 9%, then also safeguard duty is not imposed. Next point, we need to know what is the meaning of this word called anti-dumping duty. And I'm sure we know what is anti-dumping duty. Anti-dumping duty is a duty which is imposed when the goods are sent to India at less than their price prevailing in that country. That means export price is less than normal price. So for example, let us say there is one product which is sold in foreign for 100 rupees, but it is sold to India only at 80 rupees. That is nothing but dumping. And that 20 rupees will be called as dumping margin. It is called as what, my dear friends? Dumping margin. It is clearly a case of dumping because export price is less than the normal price prevailing in that country. Then the difference will be known as dumping margin, and on that margin of dumping, anti-dumping duty is levied. So we should have a clarity of thought on what is different between anti-dumping duty and what is difference between safeguard duty. These are the two major types of duty what we have got. Of course, there is something called basic customs duty, IGST, social welfare surcharge. I'm sure we guys know that in case of imports, the accessible value is always CIF. But in case of exports, the accessible value is always FOB. Now, when I talk about imports, where accessible value is CIF, which is nothing but cost, insurance, and freight. Ultimately, whatever is given in the question, I will take utmost effort to reach the figure of CIF, which is nothing but cost, insurance, and freight. And on this cost, insurance, and freight, we will charge BCD. What will I charge, my dear friends? BCD. And which day you will see BCD rate? In case of imports by vessel, we will see the rate of BCD on the date of filing bill of entry for home consumption or entry inwards, whichever is earlier. And in case of imports by other than vessel, date of filing bill of entry for home consumption or arrival, whichever is later. You're getting my point, my dear friends? So basis that we will see whichever is later, we will look at what is the rate of BCD. Lateral logic is very simple because imagine you filed a bill of entry for home consumption, but the goods have not yet arrived. Then how will you take the goods? Goods have already arrived, but you can take the goods only after filing bill of entry for home consumption. You're getting my point? So then, apart from that BCD, my dear friends, we will also charge social welfare surcharge at the rate of 10% on BCD. Then we get complete total. On this complete total, we will charge IGST at a percentage on this total. And the total customs duty payable will be BCD plus SWS plus IGST. And SWS stands for social welfare surcharge. Getting my point, everyone? Wonderful. Now, there is a possibility that in the question, they have not directly given CIF, but they have given something called FOB. And we all know that FOB stands for what, my dear friends? FOB stands for free on board. On to free on board value, we will add insurance. We will add freight from foreign to India. And all put together when we add, we will get something called CIF, which is nothing but accessible value. And the interesting point to be noted is that if insurance charges If what charges, my dear friends? If insurance charges are not ascertainable, insurance charges are not ascertainable, then we will take it as 1.125% of FOB. If insurance charges are not ascertainable, we will take it as 1.125% of FOB. Second case, if freight charges are not ascertainable, we will take it as 20% of FOB. But one special point always to be kept in mind with respect to freight, that is, if goods are imported by air, the goods are imported by air, then we will take, then we will consider actual freight charges or 20% of FOB, whichever is lower. That means generally, if the freight is not ascertainable, then we will take it as 20% of FOB. I repeat again, generally, if the freight is not ascertainable, then we'll take it as 20% of FOB. But in case where goods are imported by air, even though freight charges are ascertainable, still we will take maximum 20% of FOB. I'm sure that we got a clarity of thought on this point, dear friends. That in case where freight is not ascertainable, we will take it as 20% of FOB. But in case where goods are imported by air, even though freight is ascertainable, still we will take maximum 20% of FOB. Very, very interesting point, my dear friends. Come back to the discussion. So as I was telling you, my dear friends, that is the story of a lot of interesting points related to types of duty, where there is a high probability that a question may trigger in the exam. Next topic, that is something called classification of imported and exported goods. There is not a great topic as such. Pretty simple topic, my dear friends, with respect to classification, where they have clearly given that unassembled product is also regarded as a completed product. For example, unassembled car is still regarded as car. Semi-finished car is still regarded as a complete car. And classification is generally done based on essential character. Based on essential character. And if classification is not possible, my dear friends, because they are able to classify under two particular headings. For example, one product can be classified in this heading also, this heading also. Generally, we'll always prefer a specific heading over general heading. But one product is coming under both specific headings, it is covering under both. Then we'll follow something called later the better rule. Later the better. That means whichever comes later number in that schedule of customs tariff, that will be considered. That is important because ultimately, if proper classification is not done, the rate of duty will go wrong. And they've also clearly given in the law that packing covers and cases customized for the product shall be classified along with the product itself. However, this will not apply if packing is for repeated use. So like this, some interesting points are there in classification topic. Then valuation, already I spoke a lot with you with respect to valuation about CIF, assessable value, FOB and all. But some points to be kept in mind that whenever we are doing adjustments to transaction value and all, some points are given by Rule 10 in terms of what adjustments to be done. And they clearly gave in the law, any commission brokerage is included, but not buying commission. And they have also given the law, any plans, design, sketches is also included if it is undertaken outside India. And insurance and freight, I already spoke a lot with you. And whatever cost is incurred till the time the asset is brought into India, that is only considered. But imagine, assume for a second, goods have reached Mumbai port. From Mumbai port, then the goods are going to Chennai port. Whatever cost is incurred for the transit or transshipment of goods from Mumbai port to Chennai port shall not be included. Because law clearly specified that cost incurred till the place of importation is only considered. Clear, my dear friends? Done. Next topic. Importation, exportation, transportation of goods. I already discussed with you the procedure for importation. And exportation is not a great discussion. because in export, the value of the transaction will itself be FOB. We won't even consider CIF because we're talking about exports. Next topic, warehousing, an interesting topic where you should remember the concept of the interesting bond, what I told you about, thrice the amount of duty we have to execute one into bond bill of entry for warehousing. And there is something called warehousing without warehousing. There was Supreme Court ruling in the case of Biko Lorry, where they specified that in case where importer has filed bill of entry for home consumption, but for the time being, he made an application with the officer stating that for the time being, please put the goods in public warehouse. Then that is not regarded as warehousing. That concept is known as warehousing without warehousing. In that case, whatever concept is related to warehousing, that will not apply. And in case of warehouse goods, my dear friends, after 90 days, interest will start levied. And at any given point of time, we have to remove the goods within a period of 1 year. And if we don't remove within 1 year, then penalty provisions also will come. And if we don't remove within 90 days, as I told you already, then interest will start coming at 15% per annum. And this 90 days story, 1 year story, time limit will not apply in case of EOU, EHTPs, and also in case where manufacturing is allowed in that warehouse. In that warehouse, if manufacturing is allowed, then this time limit of 1 year will not apply. Next, finally, we have a topic called duty drawback. This is also an interesting topic, my dear friends, wherein I'm sure we guys know the importance of this topic called duty drawback. Whenever a case where imported goods are directly exported without use, please export within 2 years, will give you a drawback of 98%. And if exported after use, then the drawback percentage will change based on length of usage. Not more than 3 months, 3 months to 6 months, 6 months to 9 months, 9 to 12, 12 to 15, 15 to 18. More than 18, no drawback. And the percentages are 95, 85, 75, 70, 65, 60, like that. Percentages are given in drawback. But in case of some products, if they are exported after use, then drawback is not allowed. That is cinematographic films, paper and plates, X-ray films, then wearing apparel, tea chest. In these kind of products, my dear friends, if they are exported after use, then duty drawback is not allowed. However, if they are exported without use, my dear friends, then definitely drawback is allowed. The two drawback percentage is 98%. What percentage, my dear friends? 98% is the percentage of drawback that is allowed if goods are exported after use. And in case where imported goods are used in manufacture of finished goods and then finished goods are exported, then the drawback provisions are not given by section 75. The drawback provisions are given by section 7. I repeat again, if they are exported without use or they're exported after use, but the same product is exported, then the drawback concept is given by section 74. But if imported goods are used in manufacture of finished goods and then finished goods are exported, then the concept of drawback is given by section 75, where they have not specified the exact percentage of drawback. It depends upon whatever data is given in the question. But they have specified that the maximum drawback is 1/3 of market price. And the drawback is allowed only when export price is more than import price. And sometimes in the question only they will tell that export price must be more than so and so percentage of import price. For example, they will tell import price is 100, export price minimum value addition should be 40%. That means if import price is 100, export price should be minimum 140. Then only duty drawback is allowed. You're getting my point, my dear friends? And section 76 talk about drawback is not allowed in case where the amount of drawback is less than 50 rupees. And the market price is less than the amount of drawback. In these cases, the drawback is not allowed. Section 74, 75, 76 deals with the concept of drawback. You're getting my point, my dear friends? Very interesting concept, guys. Duty drawback, high probability that question will trigger in the examination. I'm sure we are clear with this point so far, my dear friends. Exactly. Next, we have got one more topic, that is refund under customs law. And refund is also allowed in customs law, my dear friends. And in case where we have got erroneous refund, we are required to pay interest to the government at the rate of 15% per annum. And in case where we applied for refund, then they'll also give along with interest at the rate of 6% per annum. So when we are required to pay, it is 15% per annum. And when we are required to get, it is 6% per annum. Then finally, we have got one last topic in customs, that is foreign trade policy. And I'm sure we guys know very clearly that foreign trade policy is an interesting topic. We have got some interesting schemes like advance authorization, duty entitlement passbook. We have got the concept of duty-free import authorization, and there is something called EPCG, export promotion capital goods. But one point to be noted here, since last 1-2 attempts, we are not finding much questions on foreign trade policy. That doesn't mean that FTP will not come in exam. Usually prior to 1-2 attempts, FTP was coming in exam for about 4 marks. So don't take any chance, just go through that once and keep in mind about the interesting concept of the scheme. Something like advance authorization, minimum value addition is 15%, and duty-free import authorization, minimum value addition is 20%. EPCG scheme, export promotion capital goods, where they told you have to achieve something like 6 times of duty saved. So like these interesting points, you just keep in mind, because there's a high probability that a question may come in exam for 4 marks, my dear friends. Are we getting clarity? I'm sure till this point, we all are clear, my dear friends. Exactly. Wonderful participation, guys. Very good. So, friends, with this, we are done with revising once for all the interesting topic called customs and FTP, which has got a weightage of about 25 marks in the examination, on which we can't take any chance because high probability that a good number of questions will come in the exam, and it is very, very scoring area. And I keep on saying always to the student that out of this 25 marks, you have to generally aim to get minimum 15 to 20 marks, so that you will have some good cushion to score some interesting marks in GST. And indirect tax laws is one such paper where there is a high probability that we get an exemption in the examination. Since there is a high probability to get the examination, we should not effort to miss out, my dear friends. When I talk about group 2, the paper where there is a high rigorous possibility to get the exemption is your indirect tax laws paper. Getting my point, guys? That's it. So with this, we are done with revising a lot of interesting points in customs. Now let's proceed to revising some interesting elements in the topic of GST also. Ready? Yes, guys, go on. Look at the GST, guys. GST, the first topic, GST in India introduction. There, wherein at CA final level, not really much of interesting points are coming in the exam. But of course, please do keep in mind that GST is a tax on supply of all goods or services or both, except alcohol, liquor for human consumption. And there are 5 petroleum products which have been temporarily kept outside GST. That is petroleum crude, high-speed diesel, motor spirit, natural gas, aviation turbine fuel. Just keep these points in mind. And I'm sure we know that there are 2 types of supply called intrastate supply, intrastate supply. Intrastate supply, we charge CGST and SGST. Interstate supply, we charge IGST. And intrastate supply is that supply where location of supplier and place of supply both are in same state. However, if the location of supplier and place of supply are in different state, then we don't call it as intrastate supply. We will regard it as interstate supply. And if it is intrastate supply, we don't charge CGST and SGST. Instead, we will charge IGST. And we all know the fundamental concept that IGST amount is taken by central government, then it is shared with the state government. And which state they will share also, we know very clearly, because GST is a destination-based consumption tax. Tax will go to that state where goods or services are consumed. because GST is a destination-based consumption tax, but not origin-based tax. So money will go to that state where goods or services are consumed, my dear friends. Getting my point? Wonderful. Next topic, supply. In this topic of supply, it is important to keep in mind about some special elements of concept of supply, that is section 7.1c, and about something called 7.2a, my dear friends. 7.1c talks about what? Before 7.1c, there is something called 7.1a, which we all know that supply includes all forms of supply of goods or services or both, such as sale, transfer, barter, exchange, license, rental, lease, or disposal, made or agreed to be made for a consideration by a person in the course or furtherance of business. So it is important that there must be a consideration and the transaction is done by a person, and that too the transaction is done in the course or furtherance of business. And 7.1b is very interesting. Couple of times we have seen a question in the exam on 7.1b, my dear friends. And let me make you recall that 7.1b talks about import of services. What is that word? Import of services for a consideration, whether or not in the course or furtherance of business. So whether you imported for business use or you imported for personal use, still it is regarded as supply, provided it is made for a consideration. You're getting my point, everybody? Chalo guys, come on, what is section 7.1b? Import of services for a consideration, whether or not in the course or furtherance of business. Next point, looking at it, come on. Section 7.1c, something important. Transactions which are regarded as supply, even though there is no consideration. Come on, guys, what is that line I wrote? Transactions which are regarded as supply, even though there is, what, my dear friends? No consideration. Are we getting clarity, my dear friends? Come on, what is section 7.1c? Transactions which are what? Regarded as supply, even though there is no consideration. That means there is no consideration which is coming, but it is still regarded as supply. Now, what is covered in that? Let me tell you very clearly here what is covered in that story of transactions regarded as supply, even though there is no consideration. There are only 4 points which are given by the law. Point number 1, supplies between distinct or related persons in the course or furtherance of business. Before that, there is one more interesting point, that is permanent transfer or a disposal of business asset. Now, what is that line? Permanent transfer or a disposal of business asset on which ITC is claimed. Now, one point is very interesting here. The language used here is permanent transfer. That means it's permanently gone. Or disposal. That means it is disposed. What is disposed? Of a business asset on which what you have claimed. ITC is claimed. Logic is very simple. You already enjoyed input tax credit. Law is telling if you sell the asset or you sell the asset, you got money. That is anyways taxable. But imagine you have not sold the asset, but you donated that, gave it for free of cost. Law is telling, my dear friend, even though you gave it for free of cost, still it is regarded as supply. Because that point is the first point which is by section 7.1c read with schedule 1, which talks about transactions regarded as supply, even though there is no consideration. What is the first point? Permanent transfer or a disposal of business asset on which ITC is claimed. Make sense? Second point, supply between distinct or related persons in the course or furtherance of business. Now, who are these persons called distinct persons? Guys, let me tell you one interesting point. Distinct persons is nothing but PAN is same, but GST number is different. I'm sure we all know the fundamental point, that is under GST law, registration is not centralized. Registration is to be obtained state-wise. So, for example, if Shiva Teja is operating in Telangana, Shiva Teja is also operating in Maharashtra. I should take registration in Telangana also. I should take registration in Maharashtra also. So, in both the states, I have to operate. And in both the states, my dear friends, what is the story? In both the states, I have to take GST registration mandatorily. And they are regarded as distinct persons. Related persons, where one of them is controlling the other, or both are controlled by third person, or both of them together are controlling a third person. holding 26% or more in each of the entity. Or there is also a possibility of members of the same family, and family covers spouse and children. Spouse and children are always covered. Parents, brothers and sisters, only if they are dependent. That too dependent wholly or mainly. If they are dependent wholly or mainly, then they are also covered in the concept of related persons. So what the first point, my dear friends? First point talks about what? Permanent transfer or disposal of business asset on which ITC is claimed. Second point is supplies between distinct or related persons in the course or furtherance of business. And the third point is transfer of goods from principal to agent. Now, one point to be noted here: when there is a transfer of goods from principal to agent, law clearly told that supply of goods from principal to agent is regarded as supply, even though there is no consideration, provided agent is further issuing invoice to the customer in agent's own name. I repeat again, what did I just say? Transfer of goods from principal to agent is regarded as supply, even though there is no consideration, provided, I repeat again, provided agent is giving invoice to the customer in his own name. Are we getting clarity on this point, my dear friends? Everyone, sir? So what is the line I just told? Transfer of goods from principal to agent is regarded as supply, even though there is no consideration. Provided, what is the condition? Agent, when he's making the supply of goods to the customer, agent must issue invoice to the customer in his own name. So if agent is giving invoice to the customer in his own name, then only the transaction between principal to agent is taxable. If not, the transaction between principal to agent is not taxable. Clear my points? Everyone, good. So what the first point? Permanent transfer or disposal of business asset on which ITC is claimed. Second point, supply between what? Distinct or related persons in the course or furtherance of business. Third point, transfer of goods from principal to agent. And finally, last point, my dear friends, import of services by a person from a related person or from any of his establishment outside India in the course or furtherance of business. And here the word is very clear that it should be in the course or furtherance of business. But in 7.1b, the language was different. 7.1b was import of services for a consideration, whether or not in the course or furtherance of business. So that is why I keep telling one interesting language to be kept in mind by the students. That is, when we talk about import of services, I can divide this into two parts. First case, for a consideration. Second case, no consideration. And when it is for a consideration, my dear friends, again, two possibilities. In course or furtherance of business, not in course of furtherance of business. No consideration in course or furtherance of business, not in course or furtherance of business. Come on, my dear friends, how do we simplify the concept now? In first case, in both the cases, it is regarded as supply because of section 7.1b. Because 7.1b talks about something called import of services. Come on, my dear friends, what does 7.1b talks about? 7.1b talks about import of services for a consideration, whether or not in the course or furtherance of business. Come on, guys, what is the language going in the law? Import of services for a consideration, whether or not in the course or furtherance of business, it is still regarded as supply, my dear friends. Import of services for what? For a consideration, whether or not in the course or furtherance of business, it is still regarded as supply. because of section 7(1)(b), my dear friends. Are we getting clarity, everybody? So 7(1)(b) says what? Import of services for a consideration, whether or not in the course or furtherance of business. Other side, we are talking about there is no consideration. And I told you very clearly that once there is no consideration, my dear friends, what will happen? Once there is no consideration, 7(1)(b) will not come into picture. 7(1)(c) will come into picture. Getting clarity, everybody? 7(1)(b) will not come into picture. 7(1)(c) will come into picture. And here, if it is not in the course of furtherance of business, it is not a supply. And if it is in the course of furtherance of business, we will look at further classification. We'll look at what? Further classification. Whether it is from related person or it is not from related person. If it is from related person, then definitely we will say that this transaction is supply because of section 7(1)(c). And if it is not from related person, straight away, it is not a supply. So in case where there is no consideration, 7(1)(c) last point says import of services by a person from a related person or from any of his establishment outside India in the course or furtherance of business. That is also regarded as supply. So this is one interesting chart which gives a complete clarity of thought on import of services. So with this discussion, we are done with section 7(1)(b) and 7(1)(c) also. But let me discuss with you for 2 minutes what is section 7(2)(a), my dear friends. 7(2)(a) is a case where which is given by schedule 3, my dear friends. 7(2)(a) is a case given by schedule 3, which talks about transactions which are neither supply of goods nor supply of service. If it is neither supply of goods nor supply of service, what does that mean, my dear friends? If it is neither supply of goods nor supply of service, that clearly means that GST will not apply. GST will not apply. And the first point is very clear, my dear friends. Service by employee to employer, and the two, service by employee to employer in the course of employment. And that is the fundamental reason why practically salaried employees do not pay GST, irrespective of how much of salary they are getting. Because any service given by employee to employer in the course of employment is neither regarded as supply of goods nor regarded as supply of service. Second point, my dear friends, services by court or tribunal established under any law for time being in force. Services by MPs, MLAs, or any public servant, president, prime minister, and all. Next, my dear friends, come on. Sale of land and building, except construction services. Let me make you recall an interesting point that we all know, my dear friends. That is, in case of construction services, GST will apply even if a single rupee also is received prior to issuance of occupancy certificate or completion certificate. GST will not apply only in one case. I repeat once again, my dear friends, GST will not apply only in one case. That one case is a case where entire consideration, I repeat again, that one case is a case where entire consideration is received after issuance of occupancy certificate or completion certificate by the competent authority. So in case of construction service, GST will not apply only in one case. That is, entire consideration is received after issuance of completion certificate or occupancy certificate by competent authority. So even if single rupee also is received prior to OC, then GST will apply on entire value. Next one. Actionable claims other than betting, gambling, lottery. Actionable claim is nothing but an unsecured debt which can be enforced in the court of law. And they clearly told in the law that on actionable claim, GST will not apply. but GST will apply on betting, gambling, lottery. So on betting, gambling, lottery, GST will apply, my dear friends. Are we getting right on this point, everybody? Next. After that, my dear friends, services of funeral, burial, crematorium, mortuary, including transportation of deceased. And after that, we have got something called high sea sales. So goods before reaching India, when they were in transit only, the goods are sold. Then the transaction is not regarded as supply. Then supply of warehoused goods before clearance for home consumption. That is also not regarded as supply. Getting clarity, my dear friends? All of us? Then supply from outside India to outside India. And goods are not touching India. So supply of goods from a non-taxable territory to another person in non-taxable territory without the goods entering into India. That is also not regarded as supply. Technically, we call it as out and out supplies because they never touched into India. They are coming from outside and they are going also outside. So these are the interesting points given by Schedule 3, which talks about transactions which are neither regarded as supply of goods nor regarded as supply of service. And it's very clear that if it is neither supply of goods nor supply of service, obviously GST will not apply. Because we all know the fundamental fact that GST will apply only if the transaction is supply. And if the transaction is supply, then only GST will apply. You're getting my point, everybody, sir? Fantastic. Chalo, finally, let me talk about the last section in this topic, section 8, which talks about what is the difference between composite supply and mixed supply. Composite supply is that supply which is naturally bundled and one of which is a principal supply. Classic example I always gave is that hotel accommodation, morning we get complimentary breakfast. And in travel, be it a bus or train or flight, during the course of journey, we also get some snacks and food. That is called as composite supply. Composite supply is that supply where two or more supplies are naturally bundled and one of which is a principal supply. And mixed supply is that supply where two or more supplies are supplied together and they are not naturally bundled. And in case of composite supply, it is taxable at the rate of principal supply. So for example, in accommodation, it is given along with complimentary breakfast. We will not apply the GST rate of breakfast, but we'll apply the GST rate of accommodation because principal supply is accommodation. That breakfast is only an ancillary. Principal supply is that supply which is predominant supply and others are only ancillary, my dear friends. Other side, there is something called mixed supply, where two or more supplies are supplied together. And mixed supply, they clearly told in the law that mixed supply is taxable at highest rate. Come on, guys. Mixed supply is taxable at what rate, my dear friends? Mixed supply is taxable at highest rate. For example, there is a box in which, imagine there is a box in which cashew, almond, pista are all packed together. That is kaju, badam, pista are all packed in one box. They are not naturally bundled. And in that you can't say what is principal supply. Then we call that pack as a mixed supply. And once that supply is mixed supply, law clearly told in the law, please tax at what rate? Highest rate, my dear friends. So please check the rate of GST of cashew. Please check the rate of GST of almond. Please check the rate of GST of pista. And out of all these three, whichever is the highest rate, that rate of tax will apply. I'm sure we are getting complete clarity on this point, my dear friends. So come on, composite supply is taxed. How, my dear friends? Composite supply is taxable at the rate of principal supply. I repeat once again, composite supply is taxable at the rate of principal supply, whereas mixed supply is taxable at highest rate. That's it. With this story, I want to complete discussion on the concept of supply. And I'm sure we guys know some special points in supply. That is in case where an artist is sending artworks to art gallery. If an artist is sending artworks to art gallery for exhibition purpose, that is not regarded as supply. It is supply only when the artworks are actually sold. You're getting my point, my dear friends? That's one special point in the concept of supply. And one more interesting point in supply, which I'm sure we all know, my dear friends, that is about something called cost petroleum, where we clearly discussed that in case of cost petroleum, central government share of cost petroleum is straight away exempt. You're getting my point, my dear friends? Out of the total extraction, first we'll reduce the cost petroleum, then the balance what we get is called profit petroleum. So whatever central government will get the share of that profit petroleum, that will be fully exempt. Yes, guys. Then in supply, my dear friends, one more interesting point that even in case of liquidated damages, supply, it is still regarded as supply, provided the contract, which could be express contract or it could be implied contract. And there is some consideration coming by virtue of that contract. This is one latest point covered by amendments. In fact, my dear friends, in our Indigo and YouTube channel, already we posted amendments video, which is extremely important, on which we can't take any chance, we can't play any types of games, because amendments will definitely come in exam. And we already posted one separate video on RTP of May 23 attempt also. And in that RTP, there are some interesting amendments, which we discussed already in amendments video. And based on the amendments, the questions are there in RTP. Even for the RTP, there is one separate video on Indigo and YouTube channel. If you have not yet watched it, please ensure that you guys will check out and watch out. And any doubts, of course, we're always there. Next topic, chapter number 3, charge of GST. Guys, charge of GST, only 2 points to be learnt in this charge of GST and kept in mind. That is, in charge of GST, there are 2 interesting elements. Number 1, RCM. Number 2 is, my dear friends, about the concept of composition scheme. And RCM, I'm sure we all know that RCM will come in case of insurance agent to insurance company, recovery agent to bank, legal services to a business entity, and in case where services by way of sponsorship to any body, corporate or firm, security service to registered person, and one latest amendment, renting of a residential property to a registered person. If a residential property is given on rent to a registered person, that transaction is also covered under RCM, where receiver is liable to pay GST. And all this story is given by section 9.3, which talks about the cases where receiver is liable to pay GST, but not the supplier. And also, my dear friends, RCM will come in case where supplier is outside India, recipient is in India. Then also, recipient is liable to pay GST under RCM. Next, my dear friends, before we get into composition scheme, let me revise one interesting point called section 9.5, which talks about in case of certain notified services, if they are supplied through e-commerce operator is liable to pay GST. And if the e-commerce operator does not have physical presence in India, their representative in India is liable to pay GST. And if there is no representative, I repeat again, if there is what? No representative, they must appoint a representative and make him liable to pay GST. And one interesting point to be noted here, my dear friends, what are the notified services given by section 9.5? Only 3 points were notified, and one latest 4th point is also added. The 3 points are: number 1, service by way of transportation of passengers by way of radio taxi, motor cab, maxi cab, omnibus, motorcycle, or any other motor vehicle. Number 2, services of hotel accommodation, except when hotel is liable to be registered. First point was targeted towards Uber, Ola, Rapido and all. Second point is targeted towards Make My Trip, Go Ibibo. They're all targeted in this point. And the third point is services of housekeeping. I repeat again, services of housekeeping, except when person supplying service is liable to be registered. If the person supplying service is liable to be registered, then that person is only liable to pay GST. If not, who is liable to pay GST is nothing but the e-commerce operator. And last latest point, which is one very interesting latest amendment, my dear friends, restaurant service supplied through e-commerce operator. So for example, my dear friends, when we open the app of Swiggy or Zomato and place order for some food, the Swiggy or Zomato delivery guy will go to that particular restaurant, pick up that food and get it to us. In that case, we never directly make the payment to hotel. We make payment to Swiggy or Zomato. Then Swiggy Zomato makes payment to the hotel. In that case, my dear friends, they clarified that in that particular transaction also, who is liable to pay GST is e-commerce operator only. Who is liable to pay GST is e-commerce operator only. But in one exceptional case, e-commerce operator is not liable to pay GST. That exceptional case is something like this, where that restaurant is a specified premises. Specified premises means a hotel where there is at least one room. A hotel where there is at least one room where there's at least one room where there is a tariff of more than 7,500 per day. So if Shiva Teja is opening Zomato and I'm placing order of some food from a 5-star hotel where there is a room of more than 7,500 per day, in that case, who is liable to pay GST is not Zomato, but the actual hotel is only liable to pay GST. I strongly believe that we have got complete clarity on this point, my dear friends. Are we clear with this point, my dear friends? Exactly. Very good. So this is our latest amendment which has come out, especially with respect to section 9.5, which talks about cases where in case of notified services supplied through e-commerce operator is liable to pay GST. And they also specified in the law that if e-commerce operator does not have physical presence in India, their representative in India is liable to pay GST. And if there is no representative, they must appoint a representative and make him liable to pay GST. I am strongly believe that we have got complete clarity on this point, my dear friends. Everybody come on, please reply. Exactly. That is the story of section 9, subsection 5. And finally, the last point to talk in this topic of charge of GST, my dear friends, that is about composition scheme. I'm sure we know that this scheme is optional. That too optional for those whose aggregate turnover does not exceed 1.5 crore in the preceding financial year, where they'll pay a small percentage as GST and which they cannot use input, they cannot claim input tax credit, they cannot pass on input tax credit. And the rate of GST is manufacturer 0.5% plus 0.5% of turnover, trader 0.5% plus 0.5% of taxable turnover, restaurant and catering services 2.5% plus 2.5% of turnover. However, my dear friends, manufacturer of certain notified goods cannot take composition scheme. Something like pan masala, tobacco and tobacco substitutes, ice cream and other edible ice, whether or not containing cocoa, aerated waters, and some latest amendment, fly ash bricks, fly ash aggregates, fly ash blocks, and then earthen or roofing tiles. You're getting my point, my dear friends. Bricks of siliceous earths. So these are all the latest points which have come out. Building bricks, where there is no question of eligibility to opt for a composition scheme. And in some specific states, instead of 1.5 crores, it is 75 lakhs. And service providers can take 50 lakhs scheme. That is, if the turnover does not exceed 50 lakhs, they can also go for composition scheme under one section called 10-2A, where the rate of GST is just 3% plus 3%. And these guys who are under composition scheme, they can never ever take input tax credit, my dear friends. That's very clear. They can never ever take input tax credit, and whatever tax they have to pay, they'll pay only using electronic cash ledger. And they cannot issue tax invoice to the customer. Instead, they'll give a document called bill of supply. And why they can't issue invoice? Because they are not collecting tax only. How can they give tax invoice? They'll give a document called bill of supply. That is the reason why if there is a person who is procuring the goods or service from composition registered person, there is no question of claiming input tax credits. Clear? That's it. Get back, guys. That is the story of interesting elements in charge of GST. Next topic, guys, exemption from GST. I am sure we guys know that it's a very important topic, especially at CA final level. Question keeps coming in the exam for about 6 to 8 marks, sometimes 6 marks, sometimes 8 marks, sometimes 4 marks also. And there are some latest amendments, especially service by IRDA, service by SEBI, service by RBI. They all are made taxable. Hotel, where the tariff is less than 1,000, it was exempt, but even that became taxable now. So many amendments are done with respect to exemption topic. Service by cord blood banks for preservation of stem cells. It was exempt before, but now it became taxable. Service by way of fumigation in warehouse. Even this was exempt, that became taxable. And for all these amendments, we already created a separate amendments video, and RTP is also recorded, and both are posted on Indigo and YouTube channel long back. So you can check out from there, my dear friends. Clear? Exemptions, highly important topic. And keep in mind, my dear friends, high probability that question will come in exam. And of course, we have got some old points which are still important. That is services by player, umpire, referee, coach, team manager. In exam, they give commentator will tax it. Then services by performing artist in folk or classical art forms of music, dance, or theater, provided consideration does not exceed 1.5 lakh. So if it's more than 1.5 lakh, it becomes taxable. And 1.5 lakh limit will not apply if service is given as brand ambassador. Next, entry fees to what, my dear friends? Zoo, National Museum, Wildlife Sanctuary, it is fully exempt. And in case we are going to award function or a recognized sporting event or a planetarium, if the ticket price is less than 500, it is exempt. But if ticket price is more than 500, it becomes taxable. And in case of GTA, there was an exemption of 750 and 1,500. Even that has been removed now. That means it became taxable. In fact, for this attempt, there have been so many exemptions which have been removed and withdrawn. That means they all became taxable. There is a high probability that question will come in the exam on exemptions. Don't miss out, guys. Very, very interesting amendments I have done in exemptions. Next topic, place of supply. We all know very clearly that place of supply concept is dealt by IGST Act, and for that purpose we have got section 10, 11, 12, 13. And section 10 deals with place of supply in case of goods, where we have got 10(1)(a), 10(1)(b), 10(1)(c), 10(1)(d), 10(1)(e). And 10(1)(a) talks about place of supply in case where there is a movement of goods, the place where movement of goods terminates for delivery to the recipient. That is regarded as place of supply. And ultimately, it is important to properly classify place of supply, because if the location of supplier, place of supply, both are in same state, it is regarded as intrastate supply. But if location of supplier, place of supply, both are in different state, it is regarded as intrastate supply. And for intrastate, we will charge CGST and SGST. Intrastate, we will charge IGST. We know the basic fundamental points. And one point we know very clearly that imagine a case where if Shiva Teja is registered in Telangana state, and in Telangana, I paid CGST, SGST, I can definitely take credits. Next point, I also paid IGST, then also I can take credit. But if Shiva Teja of Telangana has paid CGST, SGST in different state, then law clarified that CGST, SGST paid in different state cannot be claimed as credit. That is the reason why it is important that we properly classify place of supply, because place of supply will have impact on type of supply will have impact on type of tax will have impact on availability of input tax credits. So what is section 10(1)(a), guys? In case where the movement of goods, place of supply is the place where movement of goods terminates for a delivery to the recipient. 10(1)(b), my dear friends, goods are supplied by supplier to the recipient on the instructions of third person. Technically, we call it as bill to ship to model, where they clarified that in case of bill to ship to model, place of supply is the principal place of business of such third person. That means who gave the instructions. 10(1)(c), where there is no movement of goods, place of supply is the place where nothing but in case where place where the goods are made available. Other words, place of delivery. Clear, my dear friends? Next. 10(1)(d), goods are assembled or installed. In case where goods are assembled or installed, place of supply is the place where goods are actually assembled or installed. And 10(1)(e), my dear friends, goods are supplied on board a conveyance. That means, for example, the goods are supplied during the journey on train or bus or flight. In that case, my dear friends, if goods are supplied on board a conveyance, place of supply is the place where goods are taken on board. It doesn't matter when the passenger entered. It doesn't matter from where the conveyance started. It doesn't matter where the conveyance is going. What matters is only the place where the goods are taken on board. Next. Section 11 deals with place of supply in case of imported and exported goods, where they clarified in the law that in case of imported goods, in case of what, my dear friends? Imported goods, place of supply is the location of importer. In case of what, my dear friends? Imported goods, place of supply is the location of importer. And in case of export goods, place of supply is the location outside India. So wherever you are taking the goods, that becomes the place of supply. Wherever the goods are being taken, that becomes the place of supply. Next, section 12 deals with place of supply in case where supplier and recipient both are in India. 13 deals with place of supply in case where services only, but supplier or recipient, one of them is outside India. So 12 and 13, both of them deals with services only, but 12 will come into picture when both of them are in India. But if one of them is outside India, section 12 will not apply, section 13 will apply. And 12(2) general rule says, if recipient is a registered person, then place of supply is the location of the registered person. And if recipient is an unregistered person, then if address on record exists, then place of supply will be location of recipient. And if address on record does not exist, then place of supply will be location of supplier. 12(3), place of supply in case of immovable property related service, where they clarified that in case of immovable property related service, place of supply is the place where immovable property is located or intended to be located. Place of supply is the place where immovable property is located or intended to be located. Next. 12(4), my dear friends, in case of restaurant and catering, outdoor catering, health services, beauty treatment, health service including cosmetic and plastic surgery, place of supply is the place where services are actually performed. Getting my point? Then 12(5) deals with training and performance appraisal. In case of training and performance appraisal, my dear friends, if recipient is a registered person, place of supply will be location of such person. And if recipient is unregistered person, then place of supply is the place where services are actually performed. Then 12(6) talks about admission to event. In case of admission to event, the place of supply is the place where event is actually held or the park is actually located. And 12(7), organizing an event, very important point, my dear friends. In case of organizing an event, if recipient is a registered person, place of supply will be location of such person. If recipient is unregistered person, place of supply is the place where event is actually held. However, if the event is held outside India, place of supply is location of recipient. And the same point is in immovable property also. That if immovable property is outside India, place of supply is location of recipient. Then 12(8), place of supply in case of banking and financial services. Sorry, 12(8), no, 12(8) talks about something called transportation of goods. In case of transportation of goods, my dear friends, place of supply is the place where goods are handed over for the purpose of transportation. And if goods are destined outside India, place of supply is the place of destination of such goods. And in 12(9), transportation of passengers, my dear friends, if recipient is a registered person, place of supply will be location of such person. If recipient is unregistered person, then the place of supply will be the place where passenger embarks on the conveyance for continuous journey. And return journey is always treated as a separate journey. And 12(10), place of supply in case of services supplied on board a conveyance, Place of supply is the place of supply of services supplied on board a conveyance, where they specified that place of supply is the first scheduled point of departure. First scheduled point of departure of that conveyance for the journey. So we are not talking about where goods are taken on board, because we're talking about service supplied on board a conveyance, where they specified that place of supply will be the first scheduled point of departure of that conveyance for the journey. Then 1211, telecommunication services. In case of fixed line, wherever fixed line is installed, and in case of postpaid connection, billing address, prepaid connection, if recharge is made through internet banking, then address of recipient. And if recharge is made through selling agent, address of selling agent. And if recharge is made through outside small stores like grocery stores and all, place of supply is the place where voucher is sold or prepayment is received. 1212, banking and financial services, including stockbroking. Then the place of supply is the location of recipient, if it is available. And if it is not available, then place of supply will be location of supplier. For example, Shiva Teja has got account in ICICI Bank, Telangana state. Imagine I go to Maharashtra. In Maharashtra, I took service from ICICI Bank only. Then place of supply will become Telangana, because in their records, already my Telangana address is there. But imagine in Maharashtra, I have not taken service from ICICI Bank, but I have taken service from Axis Bank. Then in their Axis Bank record, my address is not there. Then place of supply will become location of supplier. 1213, insurance services, my dear friends, where they specified that if recipient registered person, location of such person. If recipient an unregistered person, then the location of recipient will be there. And don't get it out. What if location of recipient is not available? That is not possible, guys. We were talking about something called insurance. And insurance, generally, location of recipient is available. Then 1214, advertisement service to central government, state government, local authority. And for that purpose, they gave something called Rule 3, based on how advertisement is given. Advertisement is through SMS, then it is based on telecom subscribers. Advertisement is given in TV, then it is based on number of viewers. You're getting what I'm talking, my dear friends? Exactly. And if advertisement is given on train, then it is based on length of railway track. If advertisement is given on tickets, then number of railway stations. That is the story of section 12, my dear friends. Then if one of them is outside India, section 13 will come into picture. And 13 is as good as same as 12 only, my dear friends. And in 13.2, we have got general rule, which says location of recipient. If it is available in the ordinary course of business. If it is not available, then place of supply is location of supplier. And 13.3 talks about performance-based services. And there, majorly the point is given as where service is actually performed. And 13.4, same as 12.3, guys, immovable property. And 13.5 is as good as 12.6 and 12.7. That is admission to event, organizing an event, where they told a place where event is actually held. Next. 13.6, my dear friends, if 3, 4, 5 are performed, that means 13.3, 13.4, 13.5 are performed at more than one location, including taxable territory, then place of supply will become location in taxable territory. And 13.7 says, if 13.3, 4, 5 are performed in more than one state in taxable territory, then it is apportioned in the states based on the value given in the agreement. Yes, my dear friends, good. Then 13.8, my dear friends, 13.8 talks about 2-3 interesting elements. That is 13.8, point number 1, banking services to account holders. Point number 2, intermediary services. Point number 3, hiring of means of transport, including yachts, but excluding aircraft and vessel, up to maximum period of 1 month, that is 30 days. In that case, my dear friends, place of supply will be location of supplier. 13.9, transportation of passenger goods. 13.9 is transportation of goods. 13.10 is transportation of passenger. 13.11, same story, service on board a conveyance. And the answer is absolutely the same. First scheduled point of departure of that conveyance for the journey. And 13.12, my dear friends, order service. Order service, where they told place of supply is location of recipient. And in case where order service is coming from outside India, location of recipient is deemed to be in India if any two conditions are satisfied. Something like IP address is of India, the address is given of India, country code of SIM card is of India, that is 91, and the payment is made using Indian debit card, Indian credit card, or the fixed line is installed in India. So if any two cases are satisfied, then we say that the place of supply is in India only. In case of order services, online information, database access and retrieval services. So these are the various interesting points what we have got in the topic of place of supply, my dear friends. Next topic, time of supply. I'm sure we guys have a clarity on this topic of time of supply. Please do keep in mind that in case of goods, in case of what, my dear friends? Goods. What is the general rule always? Date of invoice, which is nothing but the actual date of invoice or last date when invoice is ought to have been issued, whichever is earlier. And then when invoices ought to have been issued, if there is a movement of goods on or before date of removal, no movement of goods on or before date of delivery or make available. And in case where time of supply of goods covered under RCM, then the date, then it is earliest of following three dates. Number one, date of receipt of goods. Number two, date of payment. Number three, 31st day from date of invoice. These three dates, whichever is earlier. Now, when I talk about time of supply in case of vouchers, if they are identifiable, date of issue of voucher. And if they are not identifiable, date of redemption of voucher. And in case of there is addition in value by way of interest, late fees or penalty charged by supplier from recipient, then the time of supply will become the date when addition in value is received. So whenever the amount is received, that date will become time of supply. Now, when I talk about time of supply with respect to service, guys, interesting concept. What is the general rule? If invoice is issued within time, what is within time? Generally 30 days, 45 days in case of banks and NBFC. So if invoice is issued within time, time of supply will become date of invoice or a date of payment, whichever is earlier. And if invoice is not issued within time, time of supply will become date of completion of service or date of payment, whichever is earlier. And in case of time of supply for service covered under RCM, my dear friends, we have got two interesting dates. Number one, date of payment. Number two, 61st day from date of invoice. So date of payment or 61st day from date of invoice, these two dates, whichever is earlier, will become time of supply. So this is the story of section 12 and section 13, which talks about time of supply. And there is one more section called section 14, which talks about time of supply in case of change in rate of tax. Simple concept, guys. If service is before, invoice is before means before change in rate. Service is before, invoice is before, payment is before. Then section 14 will not apply. 14 will come into picture only when between these three dates, there is a change in rate of tax. If service is before, invoice and payment both are after change in rate, then time of supply will become date of invoice or date of payment, whichever is earlier, because both are after change in rate. But second case, service is before, invoice is before, payment is after, then the answer is date of invoice. And if service is before, payment is before, invoice is after, then the answer is date of payment. So whatever is going with service, that becomes time of supply. And if invoice or payment, invoice and payment both are not with service, then the answer is date of invoice or date of payment, whichever is earlier. So these are the interesting points what we have got in this interesting topic called time of supply, dealt by section 12, section 13, section 14 of CGST Act. Now let's look at the next interesting topic, my dear friends, that is value of supply. I'm sure in value of supply, we know very clearly that in value of supply, there is something called section 15, which clearly says that value of supply shall always mean transaction value. which is nothing but price paid or payable when supplier and recipient are not related and the price is sole consideration. Transaction value means what? Price paid or payable when supplier recipient are not related and the price is what, my dear friends? Sole consideration. And in this context, we should also know very clearly that there is something called 15.2 which talks about inclusions to transaction value, where we have got 5 points, my dear friends, 15.2 A, B, C, D, E, which says any tax, duty, cess fee, except GST and except TCS and income tax charged by supplier from recipient. 15.2b, supplier's obligation in relation to supply met by recipient. 15.2c, all incidental expenses or anything charged by supplier from recipient. 15.2d, any interest, late fees or penalty charged by supplier from recipient. And this is generally treated as inclusive of GST. That means if they give it as 8,000, we will do 8,000 into 100 by 118 to get the value, because that is interest, late fees and penalty, where supplier generally doesn't charge GST separately. So this interest, late fee, penalty, we always assume as inclusive of GST. Then 15.2e, any subsidies linked to price except subsidy from central government or state government. So if subsidy is coming from central government or state government, that is not included, but any other subsidy will be included. And 15.3 talks about, my dear friends, exclusions from transaction value. And there are only 2 exclusions, guys. Number 1, discount recorded in the invoice. Discount recorded in the invoice. And under GST law, there is no difference between turnover discount, quantity discount, trade discount, and all. Discount is a discount. That's it. So what is the first one? Discount recorded in the invoice. And second one, discount given. I repeat again. What is the second one, my dear friends? Second one talks about something called discount given after supply is made. So name only says discount is given when, sir, after supply is made. That means it is something like post supply discount. Post supply discount. Discount is given after supply is made based on agreement existing at the time of supply, and that agreement is linked to the invoice, and proportionate credit is reversed by the recipient. So there are 3 important points to be noticed here. There are 3 important points to be kept in mind. Point number 1, there is agreement existing at the time of supply. Point number 2, it is linked to the invoice. Discount is linked to the invoice. Point number 3, proportionate credit is reversed by recipient. Then also this post supply discount can be reduced. But whenever question is coming in the exam, please check whether agreement is there at the time of supply or not. Because if agreement is not there, then we can't reduce that post supply discount. Getting clarity, everybody? Post supply discount can be reduced only if there is an agreement existing at the time of supply and it is linked to the invoice and proportionate credit is reversed by recipient. And apart from valuation, at CA final level, we have also got valuation rules. Rule 27, which talks about a case where consideration is not only in money, where valuation is done in the chronological order. That is, first preference is given to open market value. If not possible, consideration in money plus market value of consideration in kind. If that is also not possible, price of goods or services of like, kind, and quality. If that is also not possible, we'll apply Rule 30. That is also not possible, Rule 31. Rule 30 talks about 110% of cost. Rule 31 talks about best judgment. Then we have got something called Rule 28, which talks about supply between distinct or related persons other than principal and agent. Because of principal and agent, we have got Rule 29. So what is Rule 29? 28 first. Supply between distinct or related person. First preference is always given to open market value. Not possible, price or services of goods, price of goods or services of like, kind, and quality. Like, kind, and quality. That is also not possible, Rule 30. That is also not possible, Rule 31. But in Rule 28, we have got 2 special points, guys. The first special point says, if a recipient, if whom, sir? Recipient is eligible for full credit. then invoice value shall be deemed to be open market value. And second special point, my dear friends, that is very clearly we know the point, that is if the goods are intended for further supply, then 90% of price charged by the recipient for supply of goods of like kind and quality to an unrelated customer. That means subsequent sale price into 90%. That is considered. Then rule 29 talks about principal to agent, where they told you can take open market value or option is given to supplier, that is 90% of price charged by the recipient for supply of goods of like kind and quality to unrelated customer. If both not possible, apply rule 30. That is also not possible, rule 31. Rule 30 is 110% of cost. Rule 31, best judgment. And in case of services, since it is practically difficult to discertain the cost, instead of 30, you can directly follow 31. That is something called best judgment. You're getting my point, guys? Exactly. Then apart from that, we have got something called rule 32, where valuation is given for special notified supplies, where in case of air travel agent, where they clearly told 5% of basic fare in case of domestic booking, 10% of basic fare in case of international booking. And for money changing activity, if RBI rate is available, the difference between RBI rate and our exchange rate will become taxable. RBI rate is not available, 1% of currency exchange. And if one foreign currency is converted into another foreign currency, then both are converted into INR. Check whichever is lower of that 1%. And special valuation rule given by 32(2)(b), which is optional, but once opted, it cannot be withdrawn. Where they told up to 1 lakh, 1% of currency exchanged. Minimum 250 per transaction. And 1 lakh to 10 lakh, 1000 plus 0.5% of amount greater than 1 lakh. And greater than 10 lakhs, 5,500. How 5,500 has come? Because on 1 lakh, 1,000. And on 9 lakh, 0.5% is 4,500. Total is 5,500 plus 0.1% of amount greater than 10 lakhs. And here they told maximum 60,000 per transaction. You're getting my point, everybody, sir? So like this, some interesting valuation rules are given. And in case of second-hand goods, they clearly told you can follow something called margin scheme. That means please pay GST only on profit. Only on margin. Selling price minus purchase price. If margin is positive, pay GST. Margin is negative, no GST. Next one. In case of life insurance, risk cover policy, entire premium. Risk cover policy, entire premium. And in case of variable policy, gross premium charge minus amount allocated for investment on behalf of policyholder. Provided to policyholder, they gave a separate receipt or a breakup is given in the receipt. And for general policy, 25% of first year premium, 12.5% of second and subsequent year premium. And in case of single premium annuity policy, 10% of premium charged. And finally, vouchers. Value of supply will be the value at which voucher can be redeemed. Other one, my dear friends, there is something called Rule 31A in case of betting, gambling, lottery, where they clearly told in case of lottery, value of supply will be 100 by 128 of face value of ticket or 100 by 128 of price notified in official gazette, whichever is higher, that becomes the value of supply. And finally, my dear friends, in value of supply, we have got something called Rule 33, which talks about something called pure agent. So for example, if Shiva Teja has collected 10,000 fees from the client for filing income tax return, and I paid 2,000 rupees of my client income tax from my bank account, then I've taken from my client 10,000 my fees plus 2,000 income tax paid on behalf of my client. Then GST will apply only on 10,000 but not on 12,000. because expenditure incurred as a pure agent shall not be considered for value of supply. So friends, with this, we have done some extensive revision with respect to lot of interesting points in the beautiful topic of value of supply. Then, my dear friends, we have got next interesting topic known as input tax credit. And I'm sure we guys know that this topic is tremendously important, wherein section 16 deals with who is eligible and conditions to claim input tax credit. Who is eligible to claim credit is only a registered person, and there are some conditions to claim input tax credit. That means recipient must have a tax paying document. Recipient must receive goods, services, or both. Supplier must pay tax to government. If supplier has not paid tax to government, recipient cannot claim credit. That means recipient can claim credit only if credit is reflecting in form GSTR 2B, and credit will reflect in GSTR 2B only if supplier has filed GSTR 1 within the due date. And last condition, recipient must file return. If these conditions are satisfied, then input tax credit can be claimed. Apart from that, one more point we kept in mind in this topic, my dear friends, that is, if you have missed out claiming credit in one particular month, you can claim credit in next month. Next month also forgot, you can claim in next month. And the maximum time limit is 30th November, following the end of financial year, or date of filing annual return. These two dates, whichever is earlier. Once upon a time, the answer was due date of return for September month. But this point is amended. High probability that question will come in the exam. And the same time limit is done even in case of returns, rectification of mistake, and even in case of issuance of credit note. So wherever reference was there for September, they extended the time limit till 30th November. So the maximum time limit to rectify the mistake, or maximum time limit to claim input tax credit, or the maximum time limit to report the credit note. In all these cases, the maximum time limit is 30th November, following the end of financial year, or a date of filing annual return, whichever is earlier. And in this topic of input tax credit, I'm sure we know about something called section 17.5 block credit. Motor vehicle where seating capacity is not more than 13%, more than 13% credit is allowed. And if motor vehicle is for transportation of goods, or it is for further supply, or it is for imparting training on such motor vehicle, then credit is definitely allowed. Second point, vessels and aircrafts. Third point, goods are imported for goods or services are taken for personal use. Then goods services taken from composition registered person, NRTP, except on goods imported by him. Next point, very important, goods lost, stolen, destroyed, or disposed of, or written off by way of gift or free samples. Next interesting point, my dear friends, in this context only, works contract service for construction of immovable property. Then goods or services taken for construction of immovable property. Immovable property does not include plant and machinery. So it is plant and machinery, then definitely credit is allowed. But plant and machinery does not include three cases: land, building, civil structure. Number 2, telecommunication towers. Number 3, pipelines laid outside the factory premises. So in these 3 points, input tax credit is not allowed. In rest all cases of plant and machinery, input tax credit is allowed. And they clearly told credit is not allowed only for construction of immovable property. Construction means repairs, renovation, alteration to the extent of capitalization to the immovable property. So if it is not capital in nature, but it is revenue in nature, then again input tax credit is allowed. Next, 17.2, I'm sure we know about something called apportionment, 17.2, 17.3, where there is something called Rule 42 in case of inputs and input services, where from total credit we will reduce what is related to block, what is related towards only towards exempted, what is related to personal. Then the balance will be taken to credit ledger. Out of that, what is exclusive related to taxable will subtract, and balance is called common credit. That credit will apportion based on turnover. And Rule 43 was talking about capital goods, which useful life is maximum 5 years. And 17.4 was talking about banking and financial institutions, where they told instead of following Rule 42, 43, do one thing. Do one thing. Simple answer. Forget block credit. Balance whatever is there. Don't divide between exempted and taxable. Take 50%. forget 50%. That's it. But this is only optional. But once you opt, you cannot withdraw in the middle of the year. That point they told in 17 subsection 4. And section 19 was dealing with the concept of job work, where they clearly told input should come back within 1 year and capital goods should come back within 3 years. But the time limit will not apply. But the time limit will not apply to molds and dies, jigs and fixtures, and in case of tools. Next, rule 20 and 21 deals with the concept of input service distributor, my dear friends. Input service, what my difference? Distributor, where they clearly told in the law that credit is distributed in the ratio of turnover during preceding financial year, and credit is distributed only to that units which are operational during current year. And if turnover during preceding financial year is not available, we'll take turnover of preceding quarter. Clear, friends? Then section 18 was talking about availability of credit in special cases, something like new registration, voluntary registration, whatever stock you have got, on that stock, happily take input tax credit. Or you converted from composition to normal, then also you can take input tax credits. Getting my point, guys? Done. And if there is a capital good on which you have taken input tax credit and that capital good you sold, then law is telling, please pay higher of the following two. Number one, ITC minus 5% per quarter or part thereof, or tax on transaction value. These two, whichever is higher, please pay to the government. So like this, my dear friends, we have got some very, very interesting points in the beautiful topic of input tax credit. And in job work, there's an interesting amendment that ITC 04, which was earlier supposed to be filed on quarterly basis, they brought for an amendment that if turnover is more than 5 crores, then please file half yearly once by 25th October and 25th April. And if turnover does not exceed 5 crores, only yearly once, that too by 25th of April. That's it. So these are the interesting points to be noted and kept in mind in the beautiful topic of input tax credit. Next topic, registration. I'm sure we know a lot of concepts in registration, especially with respect to concept of 40 lakh, 20 lakh, 10 lakhs. And of course, guys, please do keep in mind what all the cases where registration is mandatory, even though turnover does not exceed threshold limit. Something like CTP, NRTP, persons engaged in interstate taxable supply of goods, e-commerce operator required to collect tax at source, and then person supplying goods through e-commerce operator. In all these cases, registration is mandatory, even though turnover does not exceed threshold limit. And I'm sure we know the latest amendment in registration topic, that is with respect to Aadhaar authentication. Clear, friends? And it is not just only for new registration persons. Aadhaar authentication is applicable even for existing registered person. And if you don't get Aadhaar authentication done, you will not be eligible to claim refund, and you will not be eligible to file application for revocation of cancellation. That's very terrible. Clear? Then next topic, tax invoice, credit note, debit note. Already we discussed about this. And credit note, debit note, let me tell you one point, that credit note, debit note is not like your accounting perspective. In GST law, credit note, debit note, both are given by supplier only. And credit note is given in order to reduce the tax, and debit note is given in order to increase the tax. But both are given by supplier only. And a debit note is to be reported in the return in the same month in which debit note is issued. But when it comes to credit note is required to be reported in the same month, not possible to report in next month. And the maximum time limit is the due date of, that is 30th November following the end of financial year, or a date of filing annual return, whichever is earlier. This point you definitely keep in mind, guys. Next topic, accounts and records, waybill, guys. Waybill, we know very clearly that waybill is mandatory only when there is a movement of goods of value exceeding 50,000. And 50,000 we will see invoice value including tax. And we need to keep in mind that if returns are not filed continuously for 2 months, facility of generation of e-waybill is blocked. And it is blocked only for outward, but not for inward. And also in e-waybill, keep in mind about validity of waybill, guys. That it is up to 200 kilometers one day. And for any further or part thereof, it is additional day again. And in case of over-dimensional cargo or multi-modal shipment involving at least one leg by ship, it is up to 20 kilometers one day. That is interesting. Next, 12th topic, payment of tax interest. Interest, we know that the rate of interest is 18% per annum from the due date of payment. That means from expiry of due date of payment till the date of payment. So the due date is 20th. Interest will start from 21st. And payment of tax, we know that when you have to pay tax, we'll always first utilize input tax credit. We all know how to utilize credit, CFNL students. I will not discuss how to utilize the credit. And if there is anything balance to be paid, we will pay using electronic cash ledger. And how will the balance come in cash ledger? First, we'll create a challan. CPIN is generated, which is common portal identification number, which is 14-digit code valid for a period of 15 days. Using that CPIN, we'll make the payment within 15 days. Then SIN is generated, which is challan identification number. And once payment is made, only then SIN is generated. Getting my point? And to make the payment, we have got options like over the counter, net banking, NEFT, RTGS. Net banking is controlled by the banker. NEFT RTGS is controlled by RBI. And over the counter is case where we will take print of challan, go to the bank and physically make the payment. And over the counter limit is maximum 10,000. So if it is more than 10,000, we cannot use the option of OTC. Next point, TDS TCS chapter, we know very clearly that TDS will come only in case where the recipient is nothing but any department of central government or state government or governmental authority or a public sector undertaking, and there is a contract value more than 2.5 lakhs. Only if there is a contract value more than 2.5 lakhs, then only the provisions of TDS will apply. If the contract value is not more than 2.5 lakh, then the provisions of TDS will not apply. And TCS will come only in case of, my dear friends, e-commerce operator. Whenever supply is made through e-commerce operator, supply of goods or services through e-commerce operator will do TCS and make the payment to actual supplier. But this TCS story will not apply if e-commerce operator is liable to pay GST. Something like cases covered under section 9(5). In those cases, TCS story will not apply. Next, returns topic. Please do keep in mind about the late fees of returns. Already we prepared one summary chart and gave it in amendments video. Do check out and watch out, guys. And in returns, please note about the concept of QRMP scheme, an optional scheme for those whose aggregate turnover does not exceed 5 crores. And aggregate turnover means what we already know. Aggregate turnover covers all taxable supplies, exempt supplies, interstate supplies, and exports on all India basis under same PAN. And returns, please keep in mind about the due dates of GSTR1, GSTR3B, and about the interesting concept of first return, annual return. And we know that there is nothing called GST audited by chartered accountant or cost accountant now. Even though turnover is more than 5 crores, we will submit one reconciliation statement in GSTR 9C, which will be a self-certified reconciliation statement. Next point. Import and export under GST. Already we spoke about this in customs. Next point, refunds, my dear friends. Important topic. Please ensure that you keep in mind about time limit of refund. That is, we know the basic point that it is 2 years from relevant date. What is that relevant date? Please look at it. And predominantly refund is allowed. If there is excess balance in credit ledger, nobody can take refund like that. But refund is allowed only in case of zero rated supplies, which covers 2 cases. Number 1, exports. Number 2, supplies to SEZ. And second case where refund is allowed is even in case of inverted duty structure. That is, rate of tax on inputs is higher than rate of tax on outputs. Obviously, credit will get accumulated. There also refund can be claimed. And we have a specific formula for the purpose of claiming the refund. Just check out the formula because a question may come in exam on refunds. Job work, already I discussed with you, my dear friends, the time limit to file, the story of ITC 04, and input should come back within 1 year, capture should come back within 3 years. But the time limit will not apply for mounts and dies, jigs and fixtures, and in case of tools. Next, assessment and audit, section 59, 60, 61, 60 talks about something called provisional assessment. If provisional assessment is done, where assessee is unable to determine where the taxpayer is unable to determine the value or rate of tax, he can apply for provisional assessment. And after that final assessment is done, imagine if any amount is payable after final assessment is done, interest is required to be paid at 18% per annum from the due date of payment till the date of payment. But imagine provisionally you paid 1 lakh and final assessment is determined as 80,000. 20,000 will claim it as refund, for which you have to apply for refund, which they'll give within 60 days. And if the refund is not given within 60 days, interest will start from 61st day at the rate of 6% per annum. Please do keep in mind. And there is something called section 62, 63, best judgment assessment. And the time limit to complete assessment is 5 years from due date of filing annual return. And the due date to file annual return is 31st December following the end of financial year. And from there is a time limit of 5 years to do best judgment assessment. And 65, 66 talks about something called department audit and special audit. And department audit will complete within 3 months from commencement of audit, and further extension also is given. And special audit is done within 90 days, further extension another maximum 90 days. Special audit is a case where the department officer will appoint one chartered accountant or cost accountant to conduct that special audits. And the crazy point in this kind of audit is that at least 15 days prior to commencement of audit, notice is given about conducting of audits. And chapter number 18, a small procedural topic of inspection, search, seizure, and arrest. The 19th topic, demands and recovery, important topic, especially with respect to provisional attachment, where we know that it's valid for a period of 1 year. And 73, 74, 73 is a case where demand in case of determination of demand in case of other than fraud, misstatement, suppression, tax not paid, short paid, ITC wrongly availed or utilized, or refund claim erroneously. In case other than fraud, misstatement, suppression is given by 73. Fraud, misstatement, suppression is given by 74. And in 73, 74, the percentage of penalty are different. And in 73, if it is paid before notice or if it is paid after notice, then within 30 days, then there's no penalty. But if it is paid after order is passed, then there is a penalty of 10% of tax or 10,000, whichever is higher. And in case of fraud, misstatement, suppression, if it is paid before notice, then the penalty is 15% of tax. After notice within 30 days, then the penalty is 25% of tax. If it is after order within 30 days, then the penalty is, my dear friends, the penalty is 50% of tax. And if it is after order after 30 days, penalty will become 100% of tax. So the penalty will keep on increasing in case of fraud, misstatement, or suppression. Other than fraud, misstatement, or suppression, if it is paid before notice or it is paid after notice within 30 days, then there is no penalty. Penalty will come only after order is passed. And the penalty is 10% of tax or 10,000, whichever is higher. Next topic, offenses and penalties, where we need to know about very clearly what are the various cases penalty is imposed, especially section 129 and 130. 129 is all about detention and seizure. 130 is confiscation. And with detention and seizure, now penalty provisions are changed, where straight away the penalty is what, my dear friends? 200% of tax. 200% of tax is penalty. That is very important. Latest amendment, my dear friends. You need to focus upon this. Then appeals and revisions. If you go for appeal before appellate authority, please pay a pre-deposit of 100% of admitted dues plus 10% of remaining tax in dispute, subject to maximum 25 crores. 100% admitted dues plus 10% of remaining tax in dispute. If it is admitted, then please pay 100% of tax interest penalty. And if we go for appellate tribunal, my dear friends, then what is the story, sir? 100% admitted dues plus 20% of remaining tax in disputes. And we can go for High Court or Supreme Court only when there is a question of law. And when we go for appellate tribunal, there are two benches there: national bench, regional bench, state bench, area bench. We will go to national bench, regional bench only when there is a matter related to place of supply. And when we go to national bench, regional bench, after that directly we'll go to Supreme Court. And if there is no matter related to place of supply, we will go to state bench or area bench. From state bench or area bench, we will go to High Court, and after High Court, we can go to Supreme Court. Clear, friends? Then after that, we have got a procedural topic of advance ruling. where we know that there is something called we'll go for appellate, we will go for AAR, authority for advance ruling, and we can go for a AAR for any matter, be it rate of tax, value of supply, availability of ITC, everything. But we can't go to advance ruling authority for determination of matter related to place of supply, because advance ruling authority is a state level authority. How can a state level authority tell the matter related to place of supply? And advance ruling, there are two members, my dear friends, in AAR. So if there is a difference of opinion between two members, what will happen? They'll refer the matter to somebody called AAR, appellate authority for advance ruling. And then one more possibility is that there is no difference of opinion and they pass the order. And if assessor is not happy, that means taxpayer is not happy, he can file appeal before appellate authority for advance ruling. Clear, friends? And advance ruling is binding only on that particular person who has obtained the advance ruling. Clear? And if advance ruling is obtained by way of fraud, misrepresentation of fact, or suppression of facts, then the advance ruling is regarded as void. Then finally, we have got a topic like miscellaneous provision, where there are small points related to power to collect statistics, anti-profiteering authority. Like this, small points are there in the topic of miscellaneous provisions, my dear friends. So with this, my dear friends, I revised all the major important topics in our syllabus of customs and also in our syllabus of GST, my dear friends. And I'm sure whatever couple of hours that time you have spent with me have been very much useful, so that we could revise everything in detail and get some great level of conceptual clarity if you have been missing something. And this is not the end of the story. Any doubts, anytime you get, you can comfortably make use of our Indigo Learn forums. Any doubt, feel free to post your doubt on the forum. We'll be more than happy to reply to your query. Because at Indigo Learn, we always ensure that we are always proactive in replying to all your queries till the date of your exam, till the time of your exam, except during exam, till the time of your exam, we'll be more than happy to reply to all your forum queries, and we'll be more than happy to support in your professional journey. So friends, with this, I'll complete our rapid revision of CA Final Indirect Tax Laws, the last paper of CA Final, but one of the most amazing and scoring paper where there is a high possibility to secure the marks in the examination. So I wish you all the very, very best, my dear friends, and I wish you all success. Do come out with flying colors. So Shiva Teja signing off, my dear friends. Any doubt, feel free to comment on the YouTube channel or post on the forum queries. We'll be more than happy to reply to your queries, guys. Thank you so much. Shiva Teja signing off. Good night. Take care. Thank you. All the very, very best, guys.